Welcome to our comprehensive guide on understanding investment returns. Whether you're a seasoned investor or just getting started, this video will provide you with valuable insights, real-life examples, and strategies to maximize your returns. First, let's define what an investment return is. In simple terms, an investment return is the gain or loss made on an investment, typically expressed as a percentage of the initial investment. This can be positive or negative, depending on the performance of the asset. To determine the return on investment, ROI, you can use the following formula. For instance, if you invested $1,000 in a stock and it grew to $1,200, your net profit would be $200. Plugging these values into our ROI formula, we get investment returns can come from various sources such as income, profits, and capital gains. Let's explore these in further detail. Income. This can be in the form of dividends from stocks, interest from bonds, or rental income from real estate. For example, if you own shares in a company and it pays dividends, this money is considered part of your investment return. Profits. If you invest in a business, the profits made by that business will contribute to your investment return. For example, owning a piece of a startup that eventually turns profitable can be very rewarding. Capital gains. This is the increase in the value of an asset or investment over time. For example, if you purchase a piece of land for $10,000 and sell it for $15,000, the $5,000 gain is your capital gain. Next, let's delve into some common types of investments and their typical return rates. This will help you in choosing the right type of investment for your financial goals. Stocks. Historically, stocks tend to offer higher returns compared to other assets, averaging around 7% to 10% per year after inflation over the long term. However, they also come with higher risks. Bonds. Bonds are generally considered safer than stocks and tend to provide lower returns, averaging around 2% to 5% per year. Bonds are loans to the government or corporations that pay back with interest. Real estate. Real estate investments can vary widely, but on average, they yield returns of around 8% to 12% per year. Real estate can provide income through rent and potential capital gains over time. Mutual funds. These investment vehicles pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Mutual funds can average around 4% to 7% returns per year. ETFs, or exchange-traded funds. These are similar to mutual funds, but trade on stock exchanges. On average, ETFs provide returns of around 4% to 8% per year, with the added benefit of liquidity. Now, let's move on to some real-life examples to illustrate how different investment strategies can yield different returns. Example 1. Long-term stock investment. Consider you invested $10,000 in Apple Inc. APL stock 10 years ago. The stock was priced at $50 per share back then. Today, Apple stock is trading at $150 per share. The number of shares you bought, 10,000 divided by 50, is equal to 200 shares. Current value of your shares, 200 times 150 is equal to $30,000. Net profit, $30,000 to $10,000 equals $20,000. ROI, $20,000/$10,000 x 100 equals 200%. Example 2. Real estate investment. Imagine you bought a rental property for $200,000, and over a period of 5 years, it appreciated to $250,000. You also earned $5,000 annually in rental income during this time. Appreciation. $250,000 to $200,000 equals $50,000. Rental income. 5x $5,000 equals $25,000. Total profit. $50,000 plus $25,000 equals $75,000. ROI. $75,000/$200,000 x 100 equals 37.5%. Example 3. Bond investment. You purchased $10,000 worth of 5-year government bonds with an annual interest rate of 3%. Over the 5 years, you receive $300 annually in interest. Total interest earned. 5x $300 equals $1,500. Total value. $10,000 plus $1,500 equals $11,500. ROI. $1,500 slash $10,000 x 100 equals 15%. Understanding historical performance and examples, you might wonder how to choose the best investments. Here are some strategies. Diversify your portfolio. Don't put all your eggs in one basket. Diversifying means spreading your investments across different asset classes, such as stocks, bonds, and real estate, to reduce risk. Invest for the long term. The market can be volatile in the short term, but historically, it trends upward over the long term. Investing for the long term typically gives you better returns and reduces the impact of market volatility. Regularly review and rebalance. Keep an eye on your portfolio's performance and periodically rebalance it to ensure it aligns with your investment goals. Take advantage of tax-advantaged accounts. Utilizing retirement accounts like IRAs or 401(k)s can provide tax benefits, helping you maximize your returns. Now, let's go through some common questions about investment returns. What is the difference between nominal and real return? Nominal return is the rate of return on an investment without adjusting for inflation. Real return accounts for inflation, giving you a better sense of the actual increase in purchasing power. Should I always choose investments with the highest returns? Not necessarily. Higher returns often come with higher risks. It's essential to find the right balance between risk and return based on your financial goals and risk tolerance. How do dividends affect my investment return? Dividends are part of the income you earn from your investments in stocks. They can significantly boost your overall returns, especially when reinvested in the same or other dividend-paying stocks. Can I rely on past performance as an indicator for future returns? While past performance can provide some context, it is not a guarantee of future returns. Market conditions, economic factors, and company fundamentals can change, impacting future returns. And that's a wrap. We hope this video has given you a deeper understanding of investment returns, the different types of investments, and strategies to maximize your returns. Remember, investing takes time and patience, and with the right knowledge, you can make informed decisions to grow your wealth.